Welcome back to the deep dive. We're diving headfirst today into something really crucial, maybe even a bit mysterious sometimes, the auditor's report.
Absolutely. Think of it as the financial world's independent fact checker for a company.
Yeah, exactly. And we're basically handing you the decoder ring for it today.
Mm.
Because these reports, they're often just skimmed over.
They really are. But they are packed, packed with signals, clues about a company's health, its practices, maybe even, struggles the auditor had. If you know the code, they tell you so much.
And that's what we're doing, pulling back the curtain. We're going deep into audit opinions, those special reporting situations, the auditor's role. It's all based on the sources you gave us.
Right. So by the end, you'll actually understand what these complex documents are really saying. You'll spot the subtle stuff, the big statements.
You'll see what you might have missed before. Okay, let's get started.
Let's do it.
All right, first up, the gold standard. This is what every company wants to see. It's called an unmodified audit opinion.
Uh-huh. And if it's a public company, an issuer, they call it unqualified. A little confusing, maybe.
Yeah, different names.
But they mean the exact same thing. It's the best you can get.
So what does it mean, really? Unmodified, unqualified?
It means the auditor is saying, look, these financial statements, they're presented fairly.
Fairly.
In all material respects. That's key. And according to the right rules, usually GAAP, generally accepted accounting principles. It's basically their stamp of reliability.
Okay, so it's the clean bill of health.
Hmm?
What does this report actually look like? Can we walk through the main part?
Sure, first you've got the title. Something like Independent Auditor's Report. Or, for public companies, Report of Independent Registered Public Accounting Firm.
And that word independent, you mentioned it earlier, that's super important.
Crucial. It signals they're unbiased. It's the foundation of why you'd trust this report.
Okay, what's next?
Then the addressee who is this report for, often it's the shareholders, maybe the board of directors, shows who's overseeing things.
Makes sense.
Then you hit the opinion section. This is the core, the absolute heart of it.
This is where they actually say it's fair.
Exactly. They state the financials, present fairly in all material respects. And that word material, it basically means anything significant enough that it might change your decision as someone reading it.
Ah, okay. So not just any tiny error, but something that matters.
Right. And after the opinion, you get the basis for opinion section.
Okay, basis. So this is the how. How did they decide?
Pretty much. It says how they did the audit. For private companies, non-issuers, it'll mention GIS auditing standards generally accepted in the United States. For public ones, it's the standards of the PCAOB.
PCAOB, Public Company Accounting Oversight Board.
That's the one. And this section also talks about reasonable assurance.
Reasonable assurance. What does that actually mean for us?
It's a really vital concept. It means the auditor did enough work to be highly confident, very confident, but it's not an absolute guarantee.
So not 100% certain no errors exist.
Exactly. Think of it like a very thorough doctor's checkup. It gives a great picture, but can't promise you'll never get sick. Right? Especially if someone's actively hiding something like fraud.
Okay, that makes sense.
And this section also clearly separates responsibilities. It says management's job is preparing the statements and setting up internal controls.
Well, the auditor's job is to check it all.
Right. The auditor's role is getting that high assurance, using judgment, staying skeptical, finding risks. Oh, and for private companies, usually the auditor doesn't give an opinion on the internal controls in this report.
Yeah.
That's different for public companies.
Got it. Now, even with this clean, unmodified opinion, you said auditors can sometimes wave a flag, draw attention to something specific.
Yes, exactly. Without changing the overall opinion. One way, for non-issuers, involves something called other information.
Other information. What falls under that?
It's basically anything else included in, say, an annual report alongside the audited financials. Could be the management's discussion, maybe summary, employment data, things like that.
What's not included?
Things like press releases, analyst calls, the company website, stuff outside that formal package.
Okay. And the auditor's job isn't to audit this other info.
No, not audit it, but they have to read it carefully. They're looking for two main things: any material inconsistencies with the audited numbers, or any obvious material misstatements of fact.
So, like fact-checking the company story against the official numbers. If the audited revenue is $5 million, but management's letter boasts $20 million.
Bingo. That's a huge red flag, a material inconsistency. The auditor has to deal with that.
How do they deal with it?
Well, if the audited financials are wrong, and management won't fix them, the auditor would have to modify their opinion, like we'll discuss later. But if it's the other information that's wrong and management refuses to correct that,
Then what?
the auditor tells the board. They might even describe the problem in an other matter paragraph in their report, or in extreme cases, they might withhold the report entirely or even resign from the audit. It's a serious check. Yeah.
Wow, yeah. That's a subtle but powerful check. Okay, another thing you might see, mainly with private companies, non-issuers, are key audit matters, or comms.
Yes, non-issuers can choose to have these communicated. Comms are things the auditor judged were of most significance during the audit.
Most significance. Like what?
Often areas with high risk or where the auditor had to use a lot of professional judgment, maybe dealing with really big or unusual transactions.
And the key point for us reading the report.
The key is communicating CAMs does not change the opinion. It doesn't make it modified. It's just the auditor giving you, the reader, a bit more insight into the really complex or risky parts of their work.
Okay, that sounds quite similar to critical audit matters, CAMs, for public companies. Are they basically the same?
Very similar concept, but with a key difference. For public companies, CAMs are required, or the auditor has to explicitly say there weren't any.
Required.
And the definition's a bit more specific. It's matters they talked about with the audit committee, related to material accounts or disclosures, and involved especially challenging, subjective, or complex auditor judgment.
So the really tough calls.
Exactly. And for each CAM, the report tells you what it was, why it was challenging, how the auditor handled it, and where to find it in the financials.
But again, same bottom line as Pam.
Right. Crucially, CAMs do not alter the overall audit opinion. It's still unmodified or unqualified. They just provide more transparency about the auditor's process on the hardest parts.
Got it. One last thing under the clean opinion umbrella. Sometimes you see an unmodified opinion, but it includes a separate section mentioning substantial doubt about going concern. That sounds pretty serious for a clean report.
It is serious business, definitely. But the fact it's still in an unmodified report is the key here.
How does that work?
If the auditor believes there's substantial doubt, the company can keep operating for, say, the next year.
Yeah.
And management has properly disclosed this risk in the financial statement notes?
Ah, so the disclosure is adequate.
Yes. If the disclosure is adequate, the auditor includes this separate section pointing you directly to that note. It's like the auditor saying, heads up, read this note carefully. But because management handled the disclosure correctly according to the rules, the financial statements themselves are still considered fairly presented.
So it's a yellow flag, maybe? Not a red one.
That's a good way to think about it.
Ah.
It's a significant warning sign for you to investigate further. Definitely. Sometimes, historically, it's been an early warning before bigger problems surface. But it doesn't mean that current financials are misstated.
Okay, so that covers the ideal scenario, the unmodified or unqualified opinion, even with those extra flags like other info, cams, or going concern disclosures. But things aren't always ideal, right?
No, definitely not. Sometimes the auditor can't give that clean opinion, and that's when you get into modified opinions.
Modified opinions, what triggers those?
There are really two main reasons this happens. One, the financial statements themselves contain material misstatements. They're just wrong in some important way.
Okay, actual errors.
Right. Two, the auditor couldn't get enough appropriate audit evidence. They weren't able to check something important. We call this a scope limitation.
Got it. Misstatements or scope limits. And how does the auditor decide which modified opinion to issue?
That depends on two factors: how material the issue is and how pervasive it is.
Material we talked about big enough to matter. What does pervasive mean here?
Pervasive means the problem isn't just confined to one specific account or item. It fundamentally affects many parts of the financial statements, or it's so significant that it undermines the usefulness of the statements as a whole. Think of it like a single typo versus finding out the whole book is written in the wrong language.
Okay, big difference. So let's tackle the first reason. Material misstatements.
Yeah.
How does that material pervasive distinction play out?
If the misstatements are material but not pervasive, so significant but maybe isolated, the auditor issues a qualified opinion.
Qualified, meaning?
Meaning everything looks fair except for this specific issue we're telling you about. It qualifies the clean bill of health.
Okay. And if the misstatements are pervasive?
If they're material and pervasive, meaning they fundamentally wreck the overall fairness, the auditor issues an adverse opinion.
Adverse. That sounds bad.
It's the worst.
Yeah.
It's the auditor saying, these financial statements are not presented fairly, don't rely on them. It's a total thumbs down.
Can you give some examples of what these material misstatements might be?
Sure. It could be the company using the wrong accounting policies entirely, just not following GAAP.
Oh,
Or maybe they're applying a policy incorrectly, like say, expensing a huge machine that should clearly be capitalized as an asset.
okay.
It could also be bad presentation or missing disclosures, like completely omitting the statement of cash flows, which is required.
Hmm.
Our sources mention that specifically missing a cash flow statement would likely lead to a qualified opinion.
So how does the report wording actually change for a qualified opinion because of a misstatement?
You'll see specific language. The main opinion section will say something like, except for the effects of the matters described in the basis for qualified opinion section.
Ah, it points you somewhere else.
Exactly. And then there's a new section added, basis for qualified opinion, that spells out exactly what the problem is. For example, ABC Company stated inventories at cost. JAP requires inventories be stated at the lower of cost or market. It flags the specific departure for you.
Very clear. And for the adverse opinion, the really bad one.
The language is blunt. The opinion section will state something like, because of the significance of the matter discussed in the basis for adverse opinion section, the financial statements do not present fairly.
Wow, do not present fairly.
Yes, and the basis for adverse opinion section will go into detail about why. Maybe the company didn't consolidate a subsidiary it controls, which JAP requires. Or maybe they used appraisal values for assets instead of historical cost. And importantly, if it's an adverse opinion, you won't see sections on key audit matters or critical audit matters.
Why not?
Because if the statements as a whole aren't fairly presented, discussing the tricky bits of the audit becomes kind of moot, right? The overall picture is already declared unreliable.
Makes sense. Okay, that covers modifications due to misstatements. What about the second reason? The scope limitation not being able to get enough evidence.
Right. Sometimes the auditor just hits a roadblock. They can't perform a procedure they need to. This can also lead to either a qualified opinion or something called a disclaimer of opinion.
Disclaimer. Meaning they just don't give an opinion.
Exactly. So if the potential effects of whatever they couldn't check are material but not pervasive, they issue a qualified opinion. Like before, everything seems okay, except we couldn't check this one thing and it might be wrong.
Okay.
But if the potential effects are material and pervasive, meaning the thing they couldn't check could potentially mess up the whole picture, or if the auditor finds out they aren't independent, or if the statements weren't actually audited at all, then they issue a disclaimer of opinion.
What kind of things cause these scope limitations?
It could be circumstances. Maybe the auditor was hired too late after year-end and couldn't observe the company counting its inventory. That's a common one.
Okay, unavoidable sometimes.
Right. Or maybe they can't confirm receivables for some reason. But sometimes, and this is more worrying, the limitation is imposed by management. Maybe management refuses to give them needed documents or won't sign a representation letter.
What happens then if management blocks them?
If management imposes a limitation that could have a pervasive effect, the auditor has to ask them to remove the block. If they refuse,
Then what?
the auditor should try to withdraw from the engagement if possible. If they can't withdraw, they'd have to issue a disclaimer.
Okay. So how does the report look for a qualified opinion due to a scope limit? Different wording again.
Yes. Instead of except for the effects, it will say except for the possible effects of the matter described. See the difference? It highlights the uncertainty.
Possible effects. Because they don't know for sure.
Exactly. And the basis for qualified opinion section will explain why they couldn't get the evidence. Like, we couldn't get evidence about XYZ company's investment because we were denied access to their financial info. It tells you where the blind spot is.
And the disclaimer. When they just can't give any opinion.
The disclaimer is very direct. The section usually titled Opinion will instead say something like, we do not express an opinion on the accompanying financial statements.
Wow. Just flat out no opinion.
Yep. And the basis for disclaimer of opinion section explains all the reasons why. Couldn't observe inventory, couldn't confirm receivables, whatever it was. And they'll often state they were unable to determine whether any adjustments might have been found necessary. The whole description of the auditor's responsibilities also gets significantly shortened.
And again, no cams or cams with a disclaimer.
Correct. Just like with an adverse opinion, if you can't even form an opinion on the whole thing, discussing the specific challenging audit areas doesn't make sense. The bottom line is, we couldn't do the job properly, so we have no conclusion.
Okay, we've talked a lot about audits under the usual rules like US GAAP, but you mentioned sometimes private companies, non-issuers, use different rules, special purpose frameworks.
That's right. Public companies, issuers, have to use general-purpose frameworks like GAAP or IFRS. But non-issuers sometimes use accounting methods tailored for specific needs. These are called special-purpose frameworks, or sometimes OCBOA, other comprehensive bases of accounting.
What kinds are there?
Well, there's the cash basis. Pretty straightforward. You record revenue when cash comes in, expenses when cash goes out, maybe with some minor adjustments, like for depreciating assets. Small organizations might use this.
Simple. What else?
There's the tax basis.
Yeah.
The company prepares its financial statements using the same rules it uses for filing its income tax return. Then you have the regulatory basis, where the rules are set by a specific regulator, like an insurance commission for an insurance company.
Okay, cash, tax, regulatory, anymore.
Yep, two more main ones. The contractual basis, where the financial statements follow specific rules laid out in a contract. Maybe a loan agreement requires statements prepared a certain way.
Tailored to a specific deal.
Exactly. And finally, there's an other basis. This is kind of a catch-all for any other method that's still logical, comprehensive, consistently applied, but isn't GAAP, cash, tax, regulatory, or contractual.
So when an auditor deals with one of these special frameworks, what extra things do they need to think about?
They really need to understand why these statements are being prepared and who is going to use them. That purpose drives everything.
Right, because the framework is chosen for a reason.
Precisely.
Yeah.
They also need to make sure management understands the responsibility for disclosures specific to that framework. That means clearly describing the framework itself, explaining how it's different from GAAP.
The comparison is important.
Very. And if it's a contractual basis, explaining any significant interpretations of the contract, plus any other disclosures needed just to make sure the statements aren't misleading under that special framework.
And how does the audit report itself signal, hey, warning, this isn't GAAP?
Couple of key ways. First, the titles of the financial statements themselves must be different. You can't just call it a balance sheet if it's cash basis. It needs to be something like Statement of Assets and Liabilities Arising from Cash Transactions. Very specific.
Okay, non-GAAP titles. What else in the report?
For most of these special purpose frameworks, the auditor is required to include an emphasis of matter paragraph.
Like we talked about before. What does it emphasize here?
It specifically alerts readers that the statements are prepared using a special purpose framework, not GAAP, and importantly, that they may not be suitable for any purpose other than the stated purpose. It's a clear warning about limited usability.
And you might need an other matter paragraph, too.
Often, yes. An other matter paragraph is frequently required to restrict the use of the audit report itself. For example, if it's a contractual or regulatory basis meant only for specific parties, this paragraph says basically, this report is only for the regulator, or this report is only for the parties to this contract.
Limits who should be relying on it. Now, you mentioned something really interesting before this dual opinion scenario. When does that happen?
Right, this is pretty unique. It happens when financial statements are prepared using a regulatory basis, but they're actually intended for general use, meaning the public might see them, not just the regulator.
Okay, regulatory rules, but wide distribution.
In that specific case, the auditor issues two opinions in the same report. First, an opinion on whether the statements are presented fairly according to the special regulatory framework.
Okay, opinion one, good for the regulator's rules.
Right. Then second, an opinion on whether they're presented fairly according to GAAP. And usually this second opinion will be adverse.
Adverse, because they don't follow GAAP.
Exactly. So the auditor is saying, yes, they meet the specific regulatory rules, but no, they absolutely do not meet GAAP standards for general purpose reporting. It provides crucial clarity for anyone reading them.
That makes sense. Okay, let's circle back to those special paragraphs we touched on, the ones that can show up even in a clean, unmodified opinion. They seem really important for us readers to understand.
They absolutely are. Think of them as the auditor highlighting something with a virtual yellow marker. These paragraphs, emphasis of matter for non-issuers, other matter for non-issuers, and explanatory paragraphs for issuers, draw your attention without actually changing the bottom line opinion.
Right. The opinion stays clean. So the emphasis of matter paragraph for non-issuers, what's its job?
Its job is to highlight something that is already properly presented or disclosed in the financial statements, but it's so important it's considered fundamental to the user's understanding.
Fundamental. Like when is this required?
It's required in a few specific cases. One is a justified material change in accounting principle, like changing how depreciation is calculated if it's tied to a bigger principal shift. Another is if the auditor changes their opinion on a prior year's financials, based on new facts discovered later. And as we just covered, it's required for most special purpose frameworks.
Okay, those are the required times. But auditors can also choose to add one sometimes, using their judgment.
Yes, definitely. They might add one if there's, say, unusually significant litigation or regulatory action going on, or a major catastrophe like a hurricane that had a huge impact. Significant deals with related parties might warrant one, or unusually important events happening after year end but before the report date.
What about going concern?
Ah, good point. They might also use one if conditions that previously raised substantial doubt about going concern have now been resolved by management's plans. But the auditor still thinks the underlying situation is worth pointing out for context. It's like saying, the immediate crisis passed, but here's what happened.
So it's about drawing attention to something significant within the financials or notes. How is an other matter paragraph for non-issuers different?
Other matter paragraphs deal with things outside of what's presented or disclosed in the financial statements themselves. They're relevant to understanding the audit, the auditor's responsibilities, or the audit report itself.
Ah, context about the audit process or the report's use.
Exactly. Again, they don't modify the opinion. They're required, for example, when the use of the audit report is restricted to certain parties, or when a predecessor auditor's report on prior years isn't being reissued with the current report.
Okay, dealing with past audits.
Right. Or if the current year is audited, but prior years were only reviewed or compiled, or maybe not touched by an auditor at all, it clarifies the level of assurance on those prior periods.
Any other times they might pop up?
They can be used to restrict the use of reports on special purpose financials, like we said. Or maybe if the auditor couldn't withdraw from a management-imposed scope limit and needs to explain why they're still issuing some kind of report, likely a disclaimer. Basically, it's for clarifying things about the audit context or report limitations.
Got it. And for public companies, issuers, they use explanatory paragraphs. Similar job.
Pretty much the same function, yeah. Highlighting important stuff without modifying the unqualified opinion. For issuers, these are required for things like substantial doubt about going concern, a material change in accounting principles, or correcting a material error in previously issued financials.
Correcting past mistakes.
Yes. Also required if that other information we discussed earlier, the stuff alongside the financials, is materially inconsistent and management won't fix it. Remember the $20 million versus $5 million revenue example? That could trigger an explanatory paragraph.
Okay. So for us reading these reports, what's the big takeaway about all these special paragraphs? Emphasis of matter, other matter, explanatory?
The big takeaway is these are your signal. They are the auditor explicitly telling you, pay extra attention here. It's not necessarily bad news. It doesn't mean the audit was flawed or the opinion is negative. It just means there's a specific piece of information or context that's critical for you to understand the full picture. Don't ignore them.
Great advice. Okay, let's shift here slightly. Financial statements often show multiple years side by side, right? Like 20x2 and 20x1. Comparative statements, the auditor's report usually covers all years shown.
Generally, yes. The standard report covers all periods presented in the comparative financials.
But what if? What if the auditor realizes something now that changes their opinion about last year's numbers, which are shown alongside this year's? Can they change a past opinion?
They absolutely can, and they should update it in the current year's report if new information warrants it.
How do they signal that change?
They use an emphasis of matter for non-issuers or explanatory for issuers paragraph, and there's a handy mnemonic to remember what goes in that paragraph.
DOR CS.
DOR CS. Okay, what does that stand for? It stands for date of the previous report, the opinion type previously issued, the reason for the prior opinion, especially if it was modified, the changes that have occurred causing the update, and a statement that the current opinion is different from the one issued before.
DORCS. Date, opinion, reason, changes, statement. That's helpful. Okay, another common situation. Companies sometimes switch auditors. What happens with the prior year's financials that were audited by the old firm, the predecessor auditor?
Good question. Two main possibilities. Scenario one. The predecessor auditor reissues their report alongside the new auditor's report.
The old firm gives its blessing again.
Kind of. But they have to do some work first. They need to read the current year's statements, compare them to the prior ones they audited, get representation letters from the new auditor, the successor, and from management confirming nothing's come up that would change their old report.
A bit of due diligence.
Exactly. Their reissued report usually keeps its original date, unless something did change that requires updating, then they might dual date it.
Okay, what's scenario two? Probably more common.
Scenario two. The predecessor's report is not reissued. In this case, the current auditor, the successor, issues their report covering only the current year.
But what about the prior year numbers still sitting there?
The successor auditor must refer to them in an other matter, non-issuer or explanatory issuer paragraph. They need to state a few key things.
Like what?
They have to say the prior period financials were audited by a predecessor auditor, usually without naming them, unless the firms merged. They have to see the type of opinion the predecessor gave, and if it was modified, why, and they need to state the date of that predecessor's report.
So you still get the context for the prior year, even without the original report attached.
Precisely. It tells you someone audited it, what they concluded, and when.
And what if those prior periods were, well, never audited? Or maybe just reviewed or compiled, not fully audited?
Then those prior period columns must be clearly marked unaudited or reviewed or compiled. And the current auditor adds an other matter explanatory paragraph saying they didn't audit, review, or compile those periods and take no responsibility for them. Very clear demarcation.
Okay, one more complexity involving multiple auditors, group audits. This happens when a big company has subsidiaries or parts audited by different firms, right?
Exactly. You have the main auditor, the group engagement partner, who's responsible for the overall consolidated financial statements. But parts of the group, components, might be audited by different component auditors.
So the main auditor has to rely on work done by others. How do they handle that in their report?
They have a crucial decision to make, whether or not to make reference to the work of the component auditor in the group audit report.
To reference or not to reference? What determines that?
It depends on responsibility. If the group engagement partner decides to take full responsibility for the component auditor's work, maybe they supervised it closely, reviewed their work papers extensively, are fully confident, then they will make no reference. The group report reads as if the group auditor did everything.
Okay, taking full ownership. When would they make reference?
They choose to make reference if they want to share responsibility with the component auditor. This is only allowed if the component auditor did their work according to the relevant standards, like PCAOB standards if it's an issuer, and their report isn't restricted in its use.
And if they do make reference, what does the report say?
It gets specific. In the opinion section, and often the basis for opinion section 2, the group auditor's report will state that a portion of the financials was audited by other auditors.
They name them.
Usually not by name, just other auditors. But they do disclose the magnitude, like other auditors audited components representing 20% of total assets and 18% of total revenues.
Quantifies their contribution.
Yes. And it will clearly state that the group auditor's opinion, insofar as it relates to the amounts audited by the other auditors, is based solely on the report of the other auditors. It makes the shared responsibility crystal clear.
Okay, that clarifies how they handle teamwork across firms. Let's move to the final stretch events happening after the main accounting period ends, but before the financial statements are actually released, subsequent events.
Yes, this is a really critical period. The time between the balance sheet date, say December 31st, and the date the financial statements are officially issued or available to be issued. Things can still happen that affect the financials.
Like last-minute news flashes before the report goes public.
Exactly. And these subsequent events fall into two main types, which dictate how they're treated.
Okay, type 1.
Recognize subsequent events. These provide new information about conditions that already existed at the balance sheet date. Because they relate to something already in place, they require adjustments to the financial statements.
Can you give an example?
Sure. Let's say a company was being sued, and the lawsuit existed at December 31st. If they settle that lawsuit in January, before issuing the statements, the settlement amount gives better information about that existing liability. So they'd adjust the liability recorded on the December 31st balance sheet.
Okay, it clarifies something from the past, like a customer going bankrupt in January, confirming a receivable that already looked shaky at year-end was definitely uncollectible.
Perfect example. That bankruptcy provides evidence about the value of that receivable as of December 31st. So adjust the allowance for doubtful accounts.
Got it. So type 2 must be.
Non-recognized subsequent events. These provide information about conditions that did not exist at the balance sheet date, but arose afterward.
So genuinely new things.
Right. These do not require adjustment to the financial statements themselves. However, they might require disclosure in the notes if they're significant enough that omitting them would make the financial statements misleading.
Examples of these.
Things like issuing new bonds or stock after year-end, a major business acquisition that happens in February, a factory burning down in January, big changes in asset values that occur after the balance sheet date. These are important events, but they reflect the new period, not the one being reported on.
So disclose them, but don't change the December 31st numbers. Whose job is it primarily to track these events?
Management. Management is responsible for identifying and evaluating subsequent events right up until the financial statements are issued.
And their auditor, do they just rely on management?
No, not entirely. During the period between the balance sheet date and the date of the auditor's report, we call this the subsequent period, the auditor has an active responsibility to perform procedures to look for these events.
Actively looking. What kind of procedures?
There's a useful mnemonic here, too. Prime,
Prime. Okay.
post-balance sheet transactions. Reviewing cash receipts, cash disbursements, sales, etc., right after year-end to see if they relate to year-end balances. Representation letter. Getting a letter from management confirming they've disclosed all known subsequent events. Inquiry. Asking management and legal counsel about litigation, claims, new commitments, unusual adjustments. Minutes. Reading minutes of board and shareholder meetings held after year-end. Examine. Looking at the latest available interim financial statements for the company.
Prime. Okay, so they're actively searching up until they sign their report. What about after the audit report is issued? Does the auditor still have to keep looking?
Generally, no. Once the report is issued, the auditor has no active obligation to make further inquiries or perform procedures. Their primary fieldwork is done.
What if they learn about something significant after the report is already out there and people are potentially relying on those financials? This sounds like the real crunch time.
It absolutely is. This is where things can get very serious very fast. If the auditor becomes aware of a fact that existed at the report date, which, if they'd known it then, would have changed their report,
Then what?
they have a responsibility to act. First, they determine if the information is reliable and if people are likely still relying on the run-of-the-mill report. If yes, they must advise the client to immediately disclose the new information and its impact.
How does the client disclose?
It depends. They might need to issue revised financial statements with a new audit report. Or, if the impact can be disclosed quickly and clearly, maybe through a press release or a regulatory filing like an 8K, that might suffice. They need to ensure anyone relying on the old statements is notified.
And what if the client refuses? Refuses to disclose or revise?
That's the auditor's nightmare scenario. If the client refuses to act, the auditor has to take steps to prevent future reliance on their original report. This means notifying the board of directors first.
And if the board doesn't act?
Then the auditor may need to notify regulatory agencies, like the SEC. And critically, they must notify anyone known to be relying on the financial statements that the auditor's report should no longer be associated with them or relied upon.
Wow. Basically pulling the plug publicly.
It's a drastic step, yes. Usually involves legal counsel. It's the ultimate measure to protect the public and the integrity of the audit profession when faced with potentially misleading information.
And you mentioned dual dating earlier. Is that related to subsequent events discovered before the report is issued?
Yes, typically. If an event requiring disclosure or adjustment happens after the original planned report date, but before the report is actually issued, the auditor can choose to extend all their procedures to the new date. Or, to limit their responsibility, they can dual date the report.
How does dual dating work again?
The report keeps its original date for everything except the specific subsequent event. So it might say February 15, 20X2, except as to Note 10, which is as of March 1st, 20X2. This tells everyone the auditor only extended their work for that one specific item up to March 1st.
Okay, that limits their exposure for anything else happening between Feb 15th and March 1st.
Precisely.
Whew. Okay, what a journey. We've gone from the ideal clean opinion all the way through modified opinions, special frameworks, those important extra paragraphs, handling past reports, group audits, and finishing with subsequent events. It's a lot.
It really is. But hopefully we've pulled back the curtain enough to show how these reports aren't just boilerplate. They have a structure, a language, and they communicate critical information if you know how to read them.
We saw how the different opinions, unmodified, qualified, adverse, disclaimer, signal very different levels of assurance from the auditor.
And how those extra paragraphs, emphasis of matter, other matter, explanatory, aren't modifying the opinion, but are absolutely vital flashing lights pointing you to key context.
So the big message for you listening to this is hopefully empowerment. The next time you look at a company's annual report, don't just flip past that auditor's report.
Pause on it. Now you have the tools. Ask yourself, what kind of opinion is this? Are there any of those special paragraphs? Why might they be there?
What could those signals, the subtle ones or the really obvious ones, be telling you about the company's financial situation, big events that happened, or even the challenges the auditor faced getting you this information?
It gives you a completely different lens, a much deeper way to understand what's really going on behind the numbers. It's about financial transparency.
Absolutely. Well, that wraps up this deep dive into the world of auditors' reports. Thanks for joining us.
See you next time.